Welcome to the Weekly Option, the podcast for people interested in trading stock options. Each week, we cover trade ideas and opportunities in the stock market right now. Whether you're a beginner, a professional, or just curious about options, this is the show for you. Let's get started. Welcome to the Weekly Option. This is episode 431 on June the 12th, 2026. I'm your host, Eric, and in this week's show, we'll cover the trades from last week on the Direxion Daily Semiconductor Bear 3X ETF, Redwire Corporation, D-Wave, Quantum, and BlackBerry. And we discuss 4 new trades on Fermi Inc, Bitdeer Technologies Group, Cleanspark Inc, and Carnival Cruise Lines. Now, it's always great to hear from listeners. If you have any questions about the trades presented here on the show or even about your own positions, feel free to email me. You can email questions to eric@theweeklyoption.com. That's ERIC@theweeklyoption.com. I've also created a few videos to teach you all the basics of option trading that you'll need to know to be able to follow along with me on this show. You can visit our website and click on the videos tab to watch them, or visit the YouTube channel for the Weekly Option. Now, the equity markets finished the week less than 1% higher. The Dow Jones Industrial Average grew by 335 points, closing at 51,202 points. The S&P 500 index inched 47 points higher, ending the week at 7,431 points. And now it's time for the topic of the week. The topic of the week is hype. Today, the U.S. equity market saw the largest initial public offering ever. Many of the analysts are saying that the company, SpaceX, did not have the earnings numbers to justify its valuation. While everyone was looking at the valuation, the stock finished the day above its initial price, marking a successful IPO. Now, I agree fundamentally with the analyst. There was a lot of hype behind this IPO. It is often said that you buy the rumor and sell the fact. In this case, the hype is the rumor. Now, we watched this play out today with people buying the rumor of what could be while ignoring the facts of what is. I actually think that's the right trade. I've watched people lose money time and time again by selling these technology stocks that the industry loved without properly valuing the future potential of the company to make money. To put it short, SpaceX might be all hype right now, but I'm not going to bet against the company right now or anytime soon. For those of you who are interested, the options will start trading on Tuesday. So if you do decide to sell this one, I would do it in options and not by shorting that stock. Just saying. So just make sure you have a plan and follow it before blindly jumping in. There's a lot of hype in this one, and that's for sure. That's it for the topic of the week. Let's get into the review of last week's trades. And fair warning, there were several losses, or initial losses at least. So we're going to get quite a few good explanations going. So grab a piece of paper and a pen and feel free to put this explanation or this show into rewind a couple times just to make sure you understand. So we're going to start off with our covered call. We looked at the Direxion Daily Semiconductor Bear 3X ETF. Symbol S as in Sierra, O as in Oscar, X as in X-ray, S as in Sierra. At the time, the stock was trading for $6.84 per share. I looked at buying stock and selling the June 7 call at 90 cents, hoping for a return of 15.5% in 2 weeks. Well, shares of SOXS lost $2.13 per share, ending the week at $4.71. The call option that we sold lost 83 cents, leaving us with a net loss of $1.30 if we were to close the trade out immediately. Now, typically, I would look to roll the strike lower to cover some of the loss on the week. With only 1 week left until expiration, none of the options will cover the full loss. The math I want at this point is like this. I need the difference between the strike and the current stock price, plus the premium received by selling the option, to add up to $1.30, which is our current loss if we were to close the trade out. If it doesn't do that, we're simply increasing the likelihood of an actual loss on this trade. Instead, I plan to let the option expire worthless and keep the stock. On Monday, June 22nd, I'll sell the July call option that gives me a chance to recover my $1.30 loss. You definitely want to do the math before making an adjustment on any of these trades, definitely the covered calls. There are other adjustments that you can make, but this is the one that I prefer. Next up, we have the cash secured put. We looked at Redwire Corporation, symbol R as in Romeo, D as in Delta, W as in Whiskey. At the time, the stock was trading for $18.44 per share. I looked at selling the June 18 put at $1.80. That could give us a return of 10% in 2 weeks. Well, shares of Redwire lost $3.33, ending the week at $15.11 per share. The out-of-the-money put that we sold is now deep in the money. We will first approach this as if you have not been assigned the shares of stock. So let's keep in mind this fact, the fact that we collected $1.80 when we sold the option. So our real number is $16.20 per share. So right now, your actual loss is $1.09 per share. You could pay $3.40 to buy the put back, taking an immediate loss of $1.60. I would then see if there was an iron condor or maybe a call spread that would be worth selling to capture some of that premium. If not, I would wait until next month and look to enter another short put to recover my loss. For instance, I could buy back the June 18 put for $3.40, then sell the July 15 put at $1.85, which immediately would offset my loss and leave me with 25 cents of possible profit. Now, if you've already been assigned on the shares, I would use similar math to what I mentioned in the covered call. You'll want to recover the $1.09 I mentioned earlier, which is the break-even price of $16.20 minus the current stock price of $15.11. Now, you could sell the June 15 call at 75 cents. This would allow you to possibly capture 39 cents in the stock and keep the 75 cents of call premium, a total of $1.14. This covers your loss and leaves you with a 5 cents profit if the stock moves through the strike of the call option. Now, if the stock expires below $15.50 per share, we would keep the 75 cents of premium, and that will lower our loss to 34 cents. Then I would look to sell the at-the-money call in July, which currently would allow us to capture $1.50 in option premium, plus a possible 89 cents in the stock movement to the strike. So, as you can see, this strategy can become really lucrative even if the trade goes against you. In fact, sometimes it might be better if it goes against you. It gives you more options. Now, you really have to fully understand the mechanics of the trade and the math behind it all. Feel free to listen to this explanation over again if you need a little more help understanding. I basically explained to you the wheel strategy, which says we start with a cash secured put, and if it goes in the money and we get assigned on the stock, we then sell a call option against those shares, creating a covered call. So we go from cash secured put to covered call, and you can actually keep that cycle going and see how the premiums add up for you. All right, next we have our credit spread on D-Wave Quantum Inc., symbol Q as in Quebec, B as in Bravo, T as in Tango, S as in Sierra. At the time, the stock was trading for $23.84 per share. I looked at selling the June 23 put spread at 16 cents. That could give us a maximum possible loss of 34 cents per spread. Well, shares of D-Wave lost 49 cents, ending the week at $23.35 per share. The out-of-the-money put spread that we sold is now at the money with the stock price in between our strikes. In fact, this spread is currently 1 cent above our break-even point, which means technically we should not make an adjustment. However, this is expiration week, and we need to be sensitive to the fact that you could end up having to deal with the stock if only one strike expires in the money. I would keep track of the stock price very closely all week long. If both strikes expire in the money, you'll have a maximum loss of 34 cents. If you can buy the spread back right now for mid-price of 25 cents, your loss would be 9 cents. From there, you could sell an iron condor to recover the loss pretty easily. you definitely need to consider making an adjustment at this point just in case that stock expires between your strikes. I'm fairly confident there are some great setups to collect a nice bit of money before expiration. And then finally, we have our debit spread on BlackBerry Limited, symbol B as in Bravo, B as in Bravo. At the time, the stock was trading for $9.40 per share. I looked at buying the June 8.5, 9 call spread for 27 cents. That could give us a maximum gain of 23 cents, or that's an 85.19% return in 2 weeks. Well, shares of BlackBerry lost 22 cents, ending the week at $9.18 per share. The in-the-money call spread that we bought is still in the money, thankfully. The stock price is still 41 cents above our break-even point, so this trade is still profitable and no adjustments are needed at all. Of course, you'll want to follow the stock price closely through expiration on Friday, or really on Thursday, but it's still too early to celebrate, but so far so good on this trade. All right, so that's it for the review of last week's trades. We are 1 week away from June expiration on Thursday, June 18th. Note that equity markets in the U.S. are closed on Friday, June 19th. All new trades on today's show use the July 17th expiration date for monthly options in July. So let's start off with our covered call. I'm looking at Fermi Inc., symbol F as in Foxtrot, R as in Romeo, M as in Mike, I as in India. Stock ended the week at $7.13 per share. I'm looking at buying stock and selling the July 8 call at 95 cents, hoping for a return of 25.53% in 5 weeks. Now you enter this trade by buying stock for $7.13 and selling the July 8 call at 95 cents. This trade makes the most money if stock prices finish above $8 per share. The break-even price on this trade is $6.18. In real terms, the stock purchase will require $713, and you would collect $95 for selling the option. Next up, we have a cash-secured put on Bitdeer Technologies Group, symbol B as in Bravo, T as in Tango, D as in Delta, R as in Romeo. The stock ended the week at $17.82 per share. I'm looking at selling the July 17 put at $2.60. That could create a return of 15.29%. Now you enter this trade by selling the July 17 put at $2.60. This trade makes the most money if stock prices finish above $17 per share. The break-even price on this trade is $14.40 per share. In real terms, you'll collect $260 for selling the put option, and you'll have $1,782 locked up in case you need to purchase the stock. Next, we have our credit spread on Cleanspark Inc., symbol C as in Charlie, L as in Lima, S as in Sierra, K as in Kilo. The stock ended the week at $16.48 per share. I'm looking at selling the July 16, 15 put spread at 37 cents. That could give us a maximum possible loss of 63 cents per spread. Now you enter this trade by selling the July 16 put at $1.53 and concurrently buying the July 15 put for $1.16. This is a credit spread because we are selling the spread, and this trade makes the most money if stock prices expire above $16 per share. The break-even price on this trade is $15.63 per share. In real terms, you'll receive $37 for selling the spread and have $63 at risk. And our final trade on today's show is going to be a debit spread on Carnival Cruise Lines, symbol C as in Charlie, C as in Charlie, L as in Lima. The stock ended the week at $29.16 per share. I'm looking at buying the July 28, 29 call spread for 62 cents. That could give us a maximum gain of 38 cents, or that would be a 61.29% return in 5 weeks. Now you enter this trade by buying the July 28 call for $2.65 and concurrently selling the July 29 call at $2.03. This is a debit spread because we are buying the spread, and this trade makes the most money if stock prices expire above $29 per share. The break-even price is $28.62 per share. In real terms, you'll pay $62 to enter the spread, and your maximum gain is $38 per spread. So that's it for this week's show. Thank you guys so much for listening. Hey, summertime's here. Have a wonderful weekend. I hope you get to hop in a pool or go to the beach or however you like to enjoy this warmer weather. Have a wonderful time. And as always, happy trading. Thank you for listening to the Weekly Option Podcast. Please subscribe to our show and visit us at www.theweeklyoption.com. Disclaimer, there is a very high degree of risk involved in trading. The indicators and strategies described in this podcast are for educational purposes only and should not be construed as investment advice. For our full disclaimer, visit our website at www.theweeklyoption.com.